What's going on, Facebook and YouTube people? Welcome to our latest video today on the government CMHC incentive program, just introduced in 2019. We're going to be covering all the details. We're going to go through examples coming right up.
Thanks for visiting the Emily and Joe Show today. If this is your first time visiting, please consider subscribing and hit the bell for notifications of all of our future videos containing everything real estate. My name's Emily Barry. I'm a sales representative. This is my husband, Joe Barry, and we have a real estate team here in Niagara Falls, Ontario. However, the program we're going to talk about today is a government-funded federal program, CMHC, and this is going to affect buyers all across Canada.
So basically what it is a government equity loan, 5% or 10%, to help first-time home buyers lower their monthly payment and make housing more affordable.
Absolutely. So affordability has become a big issue. Over the last several years, prices have really gone up. So affordable housing is a crisis, not just in Niagara, but all across Canada in different real estate markets.
100%.
So first off, let's talk about who qualifies for this new government incentive.
Yeah,
Joe?
for sure. So we're talking Canadian citizens, permanent residents, non-permanent residents who are legally authorized to work in Canada, household income up to $120,000. At least one of the borrowers must be a first-time home buyer. And I think the big thing you have to know is the first-time home buyer qualification is actually based on CRA's definition. So it actually encompasses a lot more people than just technically a first-time home buyer. So you're talking about obviously first-time home buyers that have never bought a home, potentially people that have had a marriage breakdown, so they're recently divorced, and even though they may have had a marital home, a month ago, now that they're single at this stage, they would likely qualify as well. And then anyone who may have owned a home previously that has been either renting or not renting, but obviously not a homeowner for 4 years would qualify as well.
Let's talk about what type of properties qualify for this incentive program. We have resale and new construction, resale and new mobile homes, and 1 to 4 unit multifamily homes.
So you might be wondering, like, how could you buy a multi-residential property as a first-time home buyer and actually still qualify for CMHC? So if you're buying your first home and it's a multi-residential property, you're not considered an investor at this stage, so you're not going to necessarily be putting 20% down. So a couple of the mortgage people that we work with typically say that if you're a first-time home buyer buying a multi-residential property, you're looking at about a 10% down payment. So a fourplex would actually qualify for the program.
Now the property has to be in Canada, and it has to be 4-season living. So no like 3-season cottage, that wouldn't qualify.
Correct. Okay, and so just another thing to note, you'll see in some of the literature that 5% or 10% loans. So 5% would be for resale and 10% would be for new construction, but you could actually borrow 5% on new construction as well. The big thing is that you don't exceed that 20%, so it is a CMHC insured loan.
So the mortgage must be CMHC insurable. That means the total amount the buyer's putting down and borrowing from the government cannot exceed 20%. Now, Joe, what other tips and information do you have for us about the type of mortgage and down payment requirement?
Sure. So the total borrowing can't exceed 4 times the qualifying income, so that would include both the mortgage and the equity stake that CMHC has. You must have the minimum down payment. So for a lot of people, it'll be 5%. And that down payment must come from traditional sources. So it can't be like an unsecured personal loan or an unsecured line of credit. You would actually have to have the cash or withdrawal from your RRSP. It's got to be something secured or from one of those more traditional sources.
The down payment can come from a relative in the form of a gift letter, as long as you don't have to repay it back to the relative.
Absolutely. And I think this is very common. We see a lot more now as houses become less affordable. Parents, grandparents, and other relatives are actually
definitely helping out,
pitching
kids,
in.
Purchase homes. Gee, when our kids are older, we're going to have to help them.
I suspect, yeah. I suspect.
Okay, so when does this program start? Well, it actually started September 2nd of this year. The first closings are going to be November 1st, and this program is running until March 31st, 2024. So the closing date has to be no later than that date. Now, with new construction, we have to be careful, right, Joe?
Yeah, we do.
They have to put an application in 18 months prior to closing, and then just be mindful of any carry on any extensions in closing with the builder, right?
Yeah, for sure. So if you exceed 18 months from when you apply for the CMHC and when you actually close the property, you would actually need to reapply.
Okay.
So if you're buying, let's say, a condo in Toronto or Vancouver, and let's say it's 2020 and the closing date's going to be 2023, then you would get your mortgage set up with your mortgage broker and get all that done. However, you wouldn't actually be applying for the CMHC until you get within 18 months of your projected closing date. Okay, so let's talk about repayment now. So what actually triggers the repayment? So one would be if you sold the house. Two would be that it's 25 years have actually lapsed since the CMHC lent the money. Okay, and then what's really important here is that repayment is actually based on the fair market value of the home at the time you pay the loan back. So it's not based on what you purchased it for, it's based at that time when you pay it back. So you would need an appraisal. And what this means is that the government is actually participating in the fluctuation of the value of the property. So if the property value goes up, you're going to be paying, more than what you initially borrowed. But conversely, if the property goes down, I was surprised about this point. If the property goes down in value, you would actually be paying back less. So it truly is an equity stake in the property.
So the government has a share in the house. So they're
Yeah.
going to benefit if the value goes up, and they're going to not benefit.
They're going to lose if
down.
it goes down. So, and one last thing about the repayment, it does have to be paid back in full. There is no interest, and you can pay it back at any time. So you could pay it back a year later, 20 years later, if you haven't sold the home. You can choose when to pay that back. And when we talk about, really who this program's for, we'll discuss some strategies about timing of when you make that payment.
Okay, who is this program actually really good for, Joe? Let's talk about that today, because that's what everyone wants to know.
Yeah, for sure. And I think at first glance, we weren't even 100% sure until we got more details who would really want to do this, because I think it ends up being for very specific people, and we're going to discuss that.
So we want to emphasize today that the success of this program really hinders on the professional that the buyer is working with, right, Joe? The mortgage specialist has to really understand this program very well to recommend it to somebody.
Absolutely, because like we said, it is for very specific people. It's not for everybody. So you want to ensure that the mortgage person that you're dealing with is very fluent and really understands this program to make sure it's right for you. Let's talk about examples now of who would really benefit from this. And so I would say that in large part, it's for people that are really sensitive to the monthly mortgage payment. So, one of the things that the mortgage brokers won't necessarily talk to you about is, let's say, childcare costs. You have a lot of childcare costs.
Expensive, yeah.
And so, you may be a little bit more sensitive to your monthly payment. And they don't really factor that in when they're talking about your mortgage payment.
Absolutely.
And so, if you have a lot of childcare costs or you have a lot of other monthly expenses.
A lot of academic costs, like people have to pay back loans.
Yeah.
So that's a big one too.
For sure. So if you're really sensitive and that $100 or $200 really makes a big impact for you, then this program would, you'd really benefit from it.
So Joe, who should not be looking at this program, and are there any situations that it would not be good?
Well, again, I would say I caution you to talk to your mortgage professional, because this could potentially work for a lot more people. But I would say that, if you got a pretty good down payment and your financial trajectory is looking really good and you can afford the payment now, I would probably be less inclined to do this, because, as you make more money, that payment's going to become more affordable. And ultimately, I think in most markets across Canada, prices are going up, let's face it. And so you would have to pay back more. And then I think the second would be for people that plan on doing, pretty major renovations in the home. Let's say even you've already done the CMHC loan and you've been in the house for a few years, and now you're looking at doing major renovations. You're going to drastically increase the value, including a lot of sweat equity. You're doing a lot of that work yourself. I would try and repay the loan before you actually do that work, because the government is going to be benefiting from, all that work and money that you're going to be investing into it. So, if you're in a market, especially that's, skyrocketing and you're comfortable with your payment, I definitely, I would caution about getting into this, because ultimately you're going to have to pay the government more money back.
Yeah. So Joe, being very smart, has discovered a little secret about this program. Do you want to talk about that?
Yeah, so you didn't really hear about it in the news, and I haven't personally seen it in any of the examples, but one of the really neat things about this program is you actually save a significant amount of money on the actual CMHC insurance. And that's a real savings. So when we get into the examples after, you'll see that if you, let's say, borrow the money now from CMHC, buy the home, you could potentially save thousands of dollars on the actual insurance. And then if you pay it back a year later,
Ah.
you're not paying back the savings on the insurance. You're just paying back the loan, and to the extent that your house went up or down would affect
So how much money could they potentially save, numbers guy?
thousands. I think the
Thousands.
one example we're going to talk about, somebody would actually be saving, I think, $4,000 on the CMHC, and that's real savings.
Real savings.
Okay, so now we're going to be discussing the different examples here. First two examples we're going to go through is a 5% resale and then a 10% new construction. So the first example, we're looking at a resale property with a purchase price of $500,000. A minimum down payment of 5% would be $25,000, leaving you with a mortgage of $475,000. At a 5% incentive, the mortgage would be reduced to $450,000, and that would give you an approximate savings of $120 per month or $1,440 per year, assuming a 3% interest rate. Example 2, we're looking at new construction property, purchase price of $400,000, minimum 5% down payment $20,000. The mortgage without the incentive would be $380,000. With a 10% incentive, because it's new construction, the mortgage gets reduced to $340,000, and that would result in an approximate savings of $200 per month or $2,400 per year. And again, this does not factor in the CMHC insurance. This is just the savings on the mortgage itself. Let's now look at an example where we examine the impact of the incentive on the actual CMHC insurance premium. So we're looking here at a home price of $380,000 with a down payment of $20,000. Without the incentive, you're looking at a mortgage of $360,000 and a mortgage insurance premium $14,400. However, with the incentive of $19,000, the mortgage goes down to $341,000 and the new mortgage insurance premium is $10,571. So that is a significant, almost $4,000 savings on the insurance premium, and that's a real savings. You're not paying that savings back. And the difference in monthly payment, we're just looking at, $110 a month, so a $1,200 annual savings on the monthly payment. However, your savings on the insurance premium up front is almost $4,000. And again, in a lot of the talking points that I've seen about this program, they're not discussing this. And to me, this is a big factor in making this decision. And your mortgage professional should understand this stuff and be able to help you make a good decision based on your circumstances. And finally, we're just going to take a look at the impact of repayment amount depending on the fluctuation of the home price. So in this example, we have a purchase price of $400,000. This would be a new construction build here because the incentive is $40,000, so a 10% loan. So a repayment, if the fair market value goes up to $500,000, would be a $50,000 repayment. So you borrowed $40,000, you're going to repay the government back $50,000 when you eventually pay it back because your home value went up by $100,000. Now on the other side of it, imagine if your home goes down $100,000, so it's worth $300,000 when you make the payment, then you would be repaying $30,000. So you originally borrowed $40,000 and then you're repaying $30,000.
Thanks for watching our video today. Joe's very first video. He did great. And if you have any questions or comments, please comment below. We'd be happy to answer them for you.